Well, welcome back to Taking the Pulse, a healthcare and life sciences podcast. I am Lindsay Baker, joined with Maynard Nexsen healthcare attorney Matthew Roberts. Matthew, always fun to be with you.
Yes, glad you're here.
Yes, and we have another colleague joining us today. We have Maynard Nexsen attorney James Childs, who serves as the co-chair of the firm's private markets and pirate equity practice, as well as chair of the firm's venture capital and emerging growth practice. So James is a very busy man, and he is here today to share his insights on M&A and private equity considerations for life sciences organizations and startups. So James, again, thanks for penciling us in, getting us on your calendar here today to have this discussion. Can you start us out by sharing a little bit about what stage of a life sciences startup should they go ahead and engage with a lawyer?
Absolutely. Well, first, it's a pleasure to be with you all today and talk about this topic, which is very near and dear to my heart. The short answer to that question is as early as possible. Certainly no later than the formation stage, frankly, even at the ideation stage. And that's for the following reasons. Many of the most important decisions that founders will make about their company occur really at the ideation phase, and they have the most long-lasting sort of ramifications for the company. So, for example, intellectual property, and we'll talk more about this a little bit later. But certainly at the time of the creation of intellectual property, you need to make sure that the company owns it, is appropriately protected through patents or trade secret status, whatever the appropriate category might be. Oftentimes, life science companies, the very first thing they do is to negotiate a license agreement with the university or other third party. And then the terms of that license agreement are pretty critical. Obviously, the royalty rate, the equity position, other rights associated with it. So getting good counsel and making sure you have a very strong foundation of with respect to intellectual property of the company is important. Also, simple things like founder equity splits. How should you split the equity pie among the founders? I would say one of the most common issues that comes up with startups is they don't talk about, in a sort of serious way, the expected roles and responsibilities of each party. They don't talk about whether the equity should vest. And then over the first 3, 6, 9, 12 months, usually someone is not living up to the expectations. And if you don't have a vesting concept built in, or if you don't have buyback rights or forfeiture rights built in, then that can create discord among the founders. And then there are things like choice of business entity, which we'll discuss in a minute. But the shorter answer is we like to be involved as early as possible so we can effectively be your Sherpa. We may have ideas about early investors, early co-founders, early strategic partners. So the earlier we're involved, the more value we can add.
So James, thanks again for coming on. We know that a lot of startups form their own entity on their own before they talk to a lawyer. And
right.
From a perspective of having a vehicle that it can best grow with the company, what are some of the best structures that you would advise startups to think about using when they're forming a company?
So the classic or most common response to that question is a C corporation. The reason for that is that's basically the Silicon Valley playbook. So most startup companies, that especially those expect they will raise venture capital, are structured as a C corporation. One of the reasons for that is that many venture capital funds have foreign investors and tax-exempt investors, and then they have a covenant in their fund documents that say they will not invest in a U.S. trade or business in a way that gives rise to what's called UBTI for the nonprofit investors, or ECI, effectively connected income, for the foreign investors. And so they really just are prohibited from investing in non-C Corp entities like an LLC that's taxed as a partnership. Another reason is you have to be a C Corp to go public. Another reason is that most employees understand stock options and how they work, and they view that as a nice incentive. The biggest one that's really become very, very important over the last several years is what's called 1202 qualified small business stock. So if a founder of a C Corp receives stock from the company at the time it's a qualifying QSB, or qualified small business stock company, and you hold the stock for 5 years, then you can exclude the greater of $10 million or 10 times your investment from federal income taxation at the time of the sale.
Wow.
So founders love it, and they usually are capped at the 10 million because they usually don't pay for their equity. But then investors, when they come in, they love it because they can get that greater of cap on their exclusion from federal income tax, which is either $10 million or 10 times their investment. And any investor that is not a C Corp would qualify for that benefit. Now, This is important. So for a lot of reasons, companies automatically say, okay, I just want to be C Corp. They don't think about it. For life science companies in particular, it's worth also considering starting out as a limited liability company or an LLC. An LLC is taxed as a partnership, so there's no separate level of tax at the entity level like a C Corp. The reason for this is we frequently have a life science company come to us and they say, I have an opportunity to effectively sell my company multiple times. I can grant a exclusive field of use license to this other strategic for 20 million or 50 million or $100 million. Is that a problem? They say, well, it's not a problem, but you're a C Corp. So you're going to have two levels of tax. You're going to pay tax on the gain at the corporate level. And when you distribute that money out to your shareholders, you can have a second level of tax. It's a similar issue with respect to just milestone payments. If the company receives large milestone payments and intends to distribute those out to its owners, you have two levels of taxation. And it's really impossible to convert from a corporation back to an LLC without it being treated as a fully taxable liquidation of the company. The other reason is you can start out life as an LLC and frequently attract angel investors with no problem. In fact, some angel investors like to be able to receive their share of what are called passive losses generated by the business early on. They can take those losses in their personal income tax return. Also, you can issue what's called profits interest to employees, which is very tax advantageous compared to options. If you're an employee and you receive options in a corporation, you probably don't exercise them until the time of sale, and you don't have an ordinary income tax treatment on your gain. But if you have a profits interest and you hold it for a year, you'll get long-term capital gains treatment on your equity. You can only do that with an LLC. And the other issue is you can convert from an LLC to a C Corp anytime you want in a tax-free manner. So we do see, I would say, is a close second, but not too close. LLCs is a choice that can be good for a life science company.
So something as simple as the type of entity you create, James has just gone over 4 or 5 like critical issues.
Absolutely,
they can make a huge difference down the road. So
it can make a huge difference. And I'll say this as well, and I'll get to this more in a moment. But most life science companies assume they will raise venture capital, but the odds of that are frankly lower than people want to admit. And if you end up raising money from angels, family offices, and strategics, you really don't have that issue that VCs have where they can't invest in a U.S. traded business. So it can be a good choice.
Yeah.
And I should say one last thing on this topic, which is in order to get QSB stock treatment, you have to hold the investment for 5 years. And if you sell within the first 5 years, you don't even receive that benefit of the exclusion from federal income tax liability. And so you really don't know when you're going to sell. Now, probably most life science companies won't sell within 5 years, but the ones that are really hot and do really well, they could sell within 3 or 4 years for sure.
Well, that is a whole lot to think about there, James, when a lot of times you find that I would imagine these life sciences companies have predominantly, doctors and medical people involved that don't maybe have the
scientists.
The scientists, right? Like you don't have the extensive background with building a business, right? As well as legal, tax implications, all those different levels of expertise that really go into the full picture here that you're going over. Would you say that those cover the big legal mistakes that you find that they make often, or are there other legal mistakes that you're finding that some of these life science startup founders make time and time again?
So I would say there are a host of other mistakes that I try to point out early on in a company's life cycle. But one is giving away too much equity too quickly. So I mentioned earlier the issue of thinking through expectations for founders and making sure that everybody has some accountability to carrying through on what their contribution is supposed to be. But the same is true generally of anybody beyond the founder team. So I will say one mistake I see physicians and scientists make a little bit more, well, not a lot more, but a little bit more than say in the pure software tech world is being generous. They're generally very nice people, and so they feel very generous towards anybody who they view can add help. They believe they add help to their effort. So it may just be somebody who's a friend or a colleague or a mentor, and they go, oh, here's 5%, here's 10%, here's 7.5%. And what they don't realize is that equity may not seem to have a lot of value today because you're a startup, but it will obviously have tremendous value if you're successful. And you're also diluting the founder team's equity. And one of the things you have to keep your eye on is as you raise money, you get diluted from a percentage wise. So hopefully the pie is growing. But investors want to make sure the founders have adequate equity so that when they do get diluted, they're continuing to be motivated all the way through the time of sale. So for both reasons, it's important to be judicious in how much equity you grant to service providers or friends or mentors early on. Also, people tend not to vest in their equity. All equity should vest over time so that people, especially for employees, they're motivated to stay in the company. And if they leave the company before the vesting period ends, they forfeit the unvested portion. And then it's important that the company have a right to buy back the vested portion, because you don't want to have former employees who are no longer adding value locked into your cap table forever if you can avoid it. So I would just say that it's really important to think through, ask people like me and others, what is an appropriate amount of equity to give a board member? What is an appropriate amount of equity to give a advisory board member? So you have some sense of what's market, and then you have good advice around the vesting schedule and your purchase rights. Another common issue is sounds pretty simple, but don't violate securities laws. So a lot of founders, particularly first-time founders, don't realize that every time you sell equity to anyone, you are selling a security under federal and state securities laws. And there's a duty to make sure there's an exemption that is available to you for that sale. And you have this duty to provide all information that a reasonable person would deem appropriate, material information that a reasonable person would deem appropriate when making an investment decision. And there is no such thing as a friends and family exemption. So a lot of people are a little confused around that, and they just say, oh, it's my relatives, or oh, it's my good friends. Well, they're, from the securities laws perspective, they're just like any other investor. And so it's really important to consult with your counsel just to make sure you have the appropriate exemption and that you provide the appropriate paperwork. Related to that is this, what I'll call the country club broker issue. So another common fact pattern is a professor knows somebody that's wealthy or that says they are wealthy, and then they say, I know a lot of other wealthy people. Will you please pay me 10% of the amount that I help you raise? Or pay me 10%, percentage of the equity in the company based on how much that I help you raise. That violates securities laws. That person would be an unregistered broker dealer. And so if you sell securities to investors through an unregistered broker dealer, there can be a rescission. In other words, the investors may be able to get their money back one day, and you may also have other penalties assessed by the Securities Commission that's applicable to the transaction. So beware of the country club broker. The last thing I definitely wanted to mention here was don't give away a right of first refusal to purchase your company to a strategic partner too quickly. I know Matthew's heard me talk about this before,
Yep.
but we see, every strategic, pharma medical device company in the country that has ever been around the block is going to naturally ask for a right of first refusal as soon as they can. So if you ask them for some data or some small level amount of assistance or some compound or access to some resource, they're pretty quick to say, okay, but give me a right of first refusal to either develop your product, acquire your company, invest in your company, whatever it might be. It's very important you try to avoid that until the counterparty is giving you something that is really worth it. So if they're committing firmly to invest $20 million in the company, maybe that's at least a reasonable conversation to have. But certainly giving them that right, you should first and foremost avoid doing it if all possible at all times. Because, for example, if you give a strategic right of first refusal to buy your company, then that has a dampening effect, right, on your ability to go to anyone else and try to get a higher and better price, because you have to disclose to those other parties you may be talking to about a transaction, to an investment banker or otherwise, that you have already given a right of first refusal to a strategic. And don't think that you can just go to that strategic and ask them to waive it before you think about selling one day, because they generally don't do that. So there are lots of other issues. We talked earlier about choice of entity. You can get that wrong. We talked earlier about the need to protect your intellectual property and giving universities overly generous licenses. And so those are also items that you should be very careful to get right.
So speaking of universities, a lot of founders come from universities, the professors, scientists, and they've developed technology or something while they're working for the university, and the university has some license or ownership of the technology and maybe of the company that a founder creates, depending upon how entrepreneurial university or its research development arm is. So how does the equity ownership or some type of IP license by a university, how does that impact a potential investor who's thinking about putting money into a life science startup?
It's really a good question. It's really important because I think maybe founders sometimes underestimate the impact those terms can have on an investor's interest. So I would say first and foremost, let's talk about equity held by the university. So it's very normal and very common for a university to own some amount of equity in a startup when they grant exclusive license to their patent portfolio, for example, that's related to the technology or the company. The problem is sometimes they get a little bit over aggressive. And so what you want to avoid is having that equity position be too high. So you don't want it to be to take up too much of the cap table. And I would say, what is too high? It's sort of subjective. It depends on the situation, but generally speaking, definitely less than 10%. Ideally between 3 or 5% or something lower. You don't want it to be non-dilutable equity. So frequently, universities try to negotiate, I want no dilution from my equity position until I've raised some amount of money. Again, that is not well received. Any non-dilutable equity is not well received by investors. Certainly don't want it to be preferred equity. I have seen universities attempt to receive preferred equity and they try to build their accrued patent costs or some other development cost or some other amount in a liquidation preference. So it's, again, very much not market and a bad idea to give a university preferred equity. And then you can sort of talk about rights that may or may not be associated with the equity. Do they get a board seat? Do they have any consent rights or block rights? Do they even have a board observation right? Now, I'm sympathetic to universities who have, particularly those that have matured technology, pretty far down the path. Those aren't ridiculous requests. The problem is, to be blunt, investors don't want universities to have any say in business decisions. So the idea that the university could have to weigh in on whether or not to raise capital or what the terms are, or hiring and firing employees, or raising debt capital, or selling the business, and investors will not come in if universities have those rights. Certainly, they don't want, for the same reason, they don't want them to serve on the board. Now, board observation right, that is typically less of a problem. So if you really need to give a university something, you can give them that right. But I will say I've had lots of investors comment they don't even want to hear the voice in the boardroom. And again, this isn't anything that's terribly negative, or it's just universities are incredibly good at what they do. And what they don't do is actually operate startups.
Right.
And so to summarize that, I think the goal would be to just make sure the university doesn't receive too high of an equity position that ties up too much equity in the company, and they don't have any control or consent rights over the business.
James, what would you say the impact of intellectual property on the valuation of a startup would be?
It's very significant in the life sciences sector. So, of course, for many, if not all, life science companies, their core asset is their intellectual property portfolio. And of course, regulatory approvals and data become huge assets over time. But the cornerstone asset is the intellectual property. And so what they're looking for, of course, as an investor is a barrier to entry, rights that prevent other companies, if you are successful developing your product or your device or whatever, or diagnostic, whatever it might be, that other people can't just come in and copy you. And so it is important to investors to see that there is some form of intellectual property that would prevent that. Now, of course, patents are the most common method for providing that protection to investors. And of course, oftentimes you don't have issued patents, you only have patents that have been filed. So it's important that you do have an experienced patent attorney, if that is your form of IP, that has prepared the patent applications, that has done a little bit of poking around into the patent, the area at issue, so they can give the investor some comfort, frankly, that they believe, and there's no guarantee here, right? But that they believe that some patent will ultimately be allowed that is broad enough to provide some degree of protection. You sometimes hear about this freedom to operate search, I guess, theory, which is that you hire a patent firm or a patent attorney at a firm like ours to go do a search of the whole market and to issue an opinion as to whether or not there's any infringement that would result from this company. But firms really don't do that, and founders should not be paying for that. But you can have your attorney poke around a little bit and take a look at the field and get some sense of that on an informal basis, which I think is valuable. A couple of quick things I want to mention here, because intellectual property is such a cornerstone asset for most life science companies. There are two things or three things you need to get right. One is that first university license, the N license of
Yes.
technology. One of the cornerstone issues is this concept of pipeline. And so there, what are you getting through the license upon the date of grant? And that would be anything that exists. Now, and then you have to look and see, is anybody on your founder team still employed by the university or the research institution? If so, it's very common for that ownership of anything they create to go to the university, and then you still need it because it didn't go to the company, because under the university's intellectual property ownership policy, if it relates to what they're doing with the university, if they're doing it on university grounds or using university resources, the university owns it. So you want to have at least something called an IP management plan in place so that you've agreed in advance. Matthew, who's an employee, can stay there. He can work on it, but anything he creates that is related to this initially licensed invention, we have a right to in-license it, or if you can get him to do it, it automatically comes in under the license. That's really important that you get that straight. A related issue is you want them to have absolute clear margins around your IP. So it's pretty important that when you look at your founder team and the product you're developing, that you consider former employers or current employers. Make sure that you haven't signed an IP assignment agreement with a former or current employer that can claim ownership to the invention or the core IP of the company. And if you think there could be some gray area, attempt to clarify it before you start building the business. Because if you go back and try to clarify it after you have something valuable and you're raising money, all of a sudden those counterparties may hold you up for some ownership or some money. The same thing is true of university. This is just my advice. There's this constant love-hate relationship between universities and their employees. It's all really love, but there's this paranoia. If I disclose something, it'll get caught up in the system, and then it'll create problems and a headache. So sometimes people try to squeak by and clean it up on the back end. That's usually not very well received for the same reason I described earlier. They're probably going to be more aggressive on resolving it than if you had just contacted them on the front end and tried to work through it. The last thing I want to mention this topic is just intellectual property assignment agreements. It sounds really simple, and I try to preach this to all my clients, but every human being that touches the invention, please have them sign a written IP assignment agreement so that you can demonstrate, and we'll talk about due diligence in a minute, but that you can demonstrate that the company owns 100% of the rights that are needed and are associated with the product at issue.
Which you'll need to be able to show that to a potential investor and or buyer.
Absolutely.
Right?
You need to be able to demonstrate that. So I guess in summary, IP is extremely important to the value of a life sciences company. And I just kind of went through some of the things you need to do to make sure you protect the value of that asset.
You referenced due diligence earlier, and if a startup is getting acquired or if there's a big significant investment, they'll go through a due diligence process. And can you talk a little bit about the process and explain how the founders should be prepared for that?
Absolutely. So due diligence is really a financial, technical, and legal audit of your company. It's kind of like getting an annual physical there, but the investor or the buyer is attempting to make sure you have your house in order and you have good corporate health and that there are no problems. That's what it is. Now, the degree of or the depth and breadth of the due diligence inquiry depends on whether it's an investor or a buyer. An investor will have a lighter touch because they're not, again, paying money off the table to you. They're investing in a growth company and they know there's risk. So they will do due diligence, but it will be a little less extensive than somebody who's buying your company. Hopefully that happens for you at the end of your life cycle. They're going to do extensive due diligence because they're not going to want to absorb any risk. Now, so it's very important that you start. The answer to the question is really simple. And I preach this to my clients. You need to start building a solid foundation from day one, develop good habits. And by the time you get to due diligence, it'll be a breeze. It's companies that try to avoid or ignore and push off all of this sort of administrative hassle associated with good housekeeping that find themselves in a really big dilemma because they can't respond actively or quickly to a due diligence inquiry, and they have holes they didn't know they had until they're responding to the due diligence inquiry. So what does that really look like? some simple things that you might imagine. Make sure you have good books and records. Make sure you keep minutes of every meeting, the stockholders and the board. Make sure you actually keep copies of all your contracts. This is a big one. You would be surprised, or maybe not, how many founders can't find a copy of the NDA they signed with the big pharma. They can't even find a copy of their partnership agreement. They can't find a copy of the employment agreement. They had everybody sign non-competes, but they lost them. They don't know where they are. So we just start saying, please, and we help many of our clients through shared data rooms, but please keep a copy of all contracts and make sure that everyone who needs them can access them. Regulatory compliance is huge, and that's one of the things Matthew does for a living, so he can speak to this as well. But make sure you understand what your regulatory environment is, and this basic stuff like data and privacy laws, HIPAA, but healthcare compliance. Obviously FDA. Everybody who's listening to this is going to have some degree of either current or future regulation by the FDA. So making sure that you have counsel and you understand what regulations apply and being compliant over time, as you should be compliant. You don't have to comply with everything at once. This is one of those things that as your product evolves and as you progress forward, you start these other regulations start layering in and being applicable to your business. So it's very important that you show full compliance. And then there's simple things like pay your taxes. And this one is interesting. You may not actually have profits as a life science company for some period of time, but there are also taxes like withholding taxes for your wages. You would be surprised how many founders make the mistake of using withholding taxes to fund their business. That is a huge red flag because it tells the investor not only do you have legal exposure, and by the way, if you do that under the IRS rules, you can be personally liable for those amounts, and the directors can be personally liable, but it shows bad judgment. And so frequently that is a disqualifier if you've done that. So pay your taxes and then comply with labor and employment laws, sort of the basic compliance regime. So that's what it means to be. And then your books and records, if you make sure you have very good books and records, a lot of people use QuickBooks. A lot of founders use QuickBooks. Nothing wrong with that, but make sure that you have some sense of how you're supposed to be, how GAAP would require you to record revenues and expenses. And I know you're not going to be GAAP compliant when you're a startup, but if you start moving towards GAAP compliance over the course of your company's life, that will be the standard by which you're judged at the time of an exit, for sure. So make sure you have good financial records as well.
So there's a lot to think about here, right? And you've got these scientists that are really focused possibly on their research or, getting to the end game of their research or being able to show in clinical data.
Right.
But James, you're bringing all these other issues to the forefront that really have to be right there at the table from the very beginning as well. Generally, if a startup is watching us right now, what would you say are the big 2 to 3 pieces of advice that you would want them to hear from you today at the beginning of their funding journey?
So I'm keying in there on funding journey. So this is facing a capital raise. I would say the first thing to understand, and this is obvious to people that do this for a living, but I guess it would not be so obvious if you don't, is there's a relatively small universe of angel investors, family offices, and venture investors that will invest in life science companies. So understand that just because there's a venture fund out there, if it doesn't say we are a life sciences focused venture fund, it will not even look at a life sciences deal. A lot of angel investors are scared to death to invest in anything that involves the words FDA, because in their minds, that means a long time frame, a lot of cost, and a lot of uncertainty around the regulatory pathway. So and this isn't a negative or positive comment. This is just saying, understand there are only certain angels that will do life science deals, and there are only certain venture funds that will invest in life science deals. I will also say, once you kind of have that understanding and you go out and hit the market, give yourself time. It takes several months to raise money, and the traditional sort of range is 3 to 6 months. Sometimes in the go-go days, if markets are hot, it can be 2, 3 months. Sometimes when you're in a tough market, it's a desert, it can take 6 months to a year. I always say plan on at least 3 to 6 months, and then kind of put your helmet on and understand you're going to have a low hit rate. So the average VC sees between 500 and 5,000, depending on the size of the VC and the scope of the VCs, how many offices they have, deals a year, and then they only do a small handful of deals. So you just need to understand that This should not dissuade you. This should not be a negative, make you feel pessimistic about things, because there's so many different investors out there. And if you have a good product, you should be able to raise money. But just kind of understand that there are going to be a lot of no's. This is almost like, it's kind of like a lawyer goes out and pitches for business. If you're not being told no, you're not asking enough. Some people don't have a problem being told no. Some people it's crushing to them. So just kind of understand, just because investors are passing on your deal, it does not mean that there's a bad deal or you should give up. It just means they're looking at thousands of deals. They have specific type of drugs or devices they're targeting, and there may not be an alignment. Um, but the last thing I think that is important and maybe all encompassing is just be very prepared and reasonable about the security you're selling and the terms you're offering to investors. Now, understand that this is really more applicable, what I'm saying now, to angel rounds and early stage rounds, because when you get to venture capital, you can kind of tell them what you want, but they really dictate what they're willing to offer. So they end up giving you a term sheet that says it's a Series A round. We want a non-participating preferred security. We want a board seat, whatever it may be. But with these earlier rounds, be thoughtful about offering the investor, a reasonable security, and then be thoughtful about giving them a reasonable deal. And this is a conversation, as you can imagine, we have a lot of conversations with founders about this, because the founder wants to avoid dilution as much as possible and wants as high valuation as reasonable. Understandable. I would too if I built a company from scratch and this was my core asset. But also understand that investor is putting hard-earned cash that is very valuable to them into a deal that has huge risk, whether or not the founder feels it. So I always view that relationship as a true partnership. And so if you approach it from that perspective, you probably heard this phrase before, and any good deal, both parties feel like they left a little on the table. That's sort of how I view raising capital. So the founders probably need to live with a little lower valuation that they would want. The investors probably have to pay a little higher valuation they want. And that's sort of our approach. So as far as the security goes, just some basic stuff, and it would probably require a whole nother segment to go through all this. But if you're early on in your fundraising process, say to your first round, you're probably going to use a safe or a note. And a safe is an instrument that is very pro-founder. It is not as good for the investor. A note is pretty pro-investor, a little less favorable to the founder. Now, the truth is, you can modify the terms of both instruments to be reasonable for both parties along that sort of middle ground that I was discussing earlier. So, but understand the difference between the two. The problem with a safe is that it's not debt. It's not treated like debt. There's no interest component. If it doesn't convert and you exit the company, the investor's only going to get their money back plus whatever the safe states the premium, if any, is. And frequently, there's not a premium. If the investor is not well represented, there may not be a premium. Whereas the benefit of the note to the investor, again, it's debt or the interest. If there's a sale, they'll get paid out first. And it's sort of a better instrument. From the founder's perspective, it's just the opposite. The founder loves the safe for that exact reason. The investor doesn't like it. And the founder wants to avoid a debt instrument because they don't want debt on their balance sheet. And they don't want to actually have, to repay it at maturity. And again, there's a way around that as well. The only other sort of security you may do early stages is Series Seed preferred security. And we're seeing more early stage Series Seed non-participating preferred financings than we have. For a long time, it's been heavy safe rounds, heavy note rounds. Then you go to your seed and A. We're now seeing if you can reach an agreement on valuation with your investor, we're seeing a little more early stage Series Seed rounds with non-participating preferred. As far as the valuation goes, again, I probably see this as a pretty common challenge for scientists that are starting a life science company. They just look at how big the market is and how game-changing this innovation would be. And if it works, it's going to be worth billions, right? And so they frequently come in and say, can we get a $100 million pre-money valuation? Can we get a $50 million pre-money valuation? Well, the reality is all these investors that are sophisticated, they know how companies like yours are being valued in Boston, Silicon Valley, all around the country. And so they have access to that data, and that the market sort of sets what your pre-money valuation is as a startup, pharmaceutical company, device company, diagnostic company, whatever it may be. And so again, going back to whoever your counsel is, kind of be aware of how companies like yours are valued, and try to be reasonable when the investor asks you what your valuation expectations are. Last couple of comments would be, I would say expect milestone-based financings if you're early stage, and frankly, even for some growth stage companies. More and more investors they would rather not just give you a check for the full amount. They would rather say, I'll give you this much that you need to get to the next stage. Whether that's preclinical or that's phase 1 or whether that's a technical milestone, because they're trying to mitigate their risk. And they're there in the trick on the negotiations is to make sure that they're obligated to put additional money in when you achieve the milestone, as opposed to just being an option. But I think you could generally expect most investors these days for earlier stage businesses in the life sciences sector to want to do some type of milestone-based financing.
Well, James, this has been awesome. You've provided a lot of great information. I hope our startups that watch this get the benefit. I know this is decades of experience coming to the forefront here. So I appreciate you coming on and joining us and sharing this with us. There'll be more to come in future episodes about life sciences.
And remember to call the attorney
at
the very beginning. And he's laid out 30 minutes of why you need to do that. So James, thank you so much here for your time with us here today. James Childs of Maynard Nexsen, along with Matthew Roberts, my colleague here at Maynard Nexsen. We appreciate it. I'm Lindsay Baker, and we'll see you right here next time for our next Taking the Pulse podcast.